Let's say after much time, you have found a business that you absolutely love. It has the right revenue, it has the right net income, is in an industry that you love and want to be in, and you're ready to execute and submit an offer to the seller. But what do? Do you make is it going to be a stock purchase or is it going to be an asset purchase? In today's video, we're going to go deep into the advantages and disadvantages of each so you can make an informed decision legally, tax-wise, and what makes most sense for you. Let's get to it. Hey everybody, welcome to my channel. I am your host, Leo Landaverde, business broker and commercial lender, helping you buy and scale a profitable business. If you're a small business owner looking to buy another business to continue to increase your wealth, or if you are a burnout corporate executive or a W-2 employee looking to get out of the rat race by purchasing a profitable business, you're in the right place. Please subscribe to my channel. Don't forget to hit the bell and you'll be notified every time a new video comes out. All right, everybody, so we begin with asset purchase. Back to the whiteboard videos. Okay, so I'm very excited because this is really what happens in the inner workings of a transaction. As I said, we're gonna begin with asset purchase. Now, the way I want you to understand an asset purchase is, imagine, if you will, that this little vehicle right here, it could be an armored truck full with cash, that is the seller's vehicle, that is, that he's been driving for maybe 20 years, been very successful. This vehicle is his legal entity where all the assets and liabilities are held through an EIN in a state number. So there's an EIN associated with it. Everything is tied to this legal vehicle, which is a legal entity that survives the owner or owners. So the seller will have a vehicle for them to conduct business. That's the element for an asset purchase for you to understand. And this right here is your vehicle. So imagine if you already have an LLC that you ever started, or with an EIN number, or a small corporation or a C corporation. You already have it set up. It is this vehicle that you're gonna take the assets from this vehicle and gonna deposit them into this vehicle. So if you understand that, all of this is going to make sense. And it has advantages and it has disadvantages. And we're going to know more whether this is more advantageous for the buyer or for the seller. So number one advantage of an asset purchase is a step-up basis on assets, which are goodwill, depreciation, and amortization. Now, those are accounting terms. So the goodwill is the amount of money that you're going to pay for the purchase of the assets of this vehicle. Well, you can actually depreciate those assets, whatever components of the assets that you choose, but the price itself, the goodwill, will be amortized possibly anywhere from 10 to 15 years, depending on the amount of money you pay for the transaction. What it does is going to sit on your profit and loss as an expense, as a non-cash expense item that you're going to get the benefit of reducing your taxable income into your vehicle. Follow me? The depreciation is the actual taking chunks of the asset over a period of time. It could be anywhere from 5 to 7, depending on how large the asset is. The life of the loan, the life of an asset is normally about 7 years. So you're going to take the cost associated with the assets and the value and depreciate them over the 7 years, and that's going to sit as a line item in your P&L. So that's what makes up EBITDA, earnings before interest, taxes, depreciation, and amortization. Okay, so that is an advantage for you as a buyer. You get to take advantage of the step-up basis on assets, which I am not going to here give you technical tax advice. It's something you should be discussing with your own CPA that handles your own business, okay? Number two, you get to cherry pick assets and liabilities you want. This is very important because an asset, it could be several assets. You have cash, you have anything that is readily convertible to cash. Usually the number one non-cash asset that a business has is its AR. So if the business has been running accrual, there's going to be accounts receivable. It's going to be sitting in the balance sheet as an asset. You get to pick portions of the assets. There may be other assets that are sitting on the balance sheet, but you get to choose whatever assets you want. And more importantly, that you get to choose liabilities that you want to take on. For instance, one of those liabilities, current liabilities, it's going to be your payroll liabilities, like associated with your pay time off or any vacation that is being earned but not paid. Is actually usually a liability for the owner that is sitting on the balance sheet as a current liability. Anything that is due within 12 months or less is a current liability. You get to choose whatever liabilities that you want, so you know with eyes wide open that this is what you're taking on, and there's a flip side to that. So I think this is a really, really big thing for buyers, not necessarily for sellers, but for buyers. Okay, which leads to number 3, that you have limited exposure, which means less due diligence. Now, quick story. So I was involved in a large M&A transaction of a privately held company being sold to a publicly traded company. It was a $25 million transaction. The due diligence alone cost the seller, actually, and the buyer over $50,000 because it was a stock sale. There was a lot of nuances to ensure that there were no potential lawsuits or anything liability-wise that was going to affect the buyer down the road. So in fact, when there is presumptive liability on a transaction, and this is big enough, there's going to be money set aside in escrow from the buyer to money that is owed to the seller in case the time comes to mitigate any of those liabilities that you may or may not know about. Sometimes sellers will not know that there is a lawsuit brewing on the side, or they may not know, or if they know, they don't want to disclose. That's something that may or may not happen. Well, if you're just buying the assets of the business, there is less due diligence. You spend less money figuring out because you already know what liabilities you are purchasing in the deal. Number 4, minority owners can be forced to accept terms. Now, if you're dealing with three shareholders, and let's just say that this is an S corp, okay, and it's an S corp on the front end, and it's treated as an S corp on the back end, and this is an LLC here with S corp tax treatment. Okay. Don't worry about the details of that now, but say this S corp, and that's 3 shareholders. One shareholder is 51%, controls the corporation, because 51% gives you control, and the other 2 are minors, and together they own 49%, 24 and 25%. So in an asset purchase, the minority owners can be forced to accept the terms. So if you strike a deal with the seller and the 51% owner, it may force the other 2 to go with it. Not necessarily happens on a stock sale. Okay. Number 5, the buyer can select which employees to retain and which to let go. Now, the most, I guess, employees can be an asset or a liability. If you have a top performing employee and you want to retain that person, but you discovered through your due diligence that there are some employees that just needed to be let go because they're non-performing. They can actually be potential harm to the business. They're disgruntled employees. Whatever the case may be, you don't want those on your payroll. You don't have to get them, if you will. They're still housed there through this legal entity. So the seller may end up laying them off because he still controls on an asset purchase the actual legal vehicle, which the unemployment taxes are associated to. So as the buyer, you have zero responsibility on the employees that are let go because of the seller, because they're not sitting on your vehicle yet. So you get to choose those. Okay, so those are some of to me, the biggest advantages of an asset purchase. But an asset purchase also has disadvantages. So let's go over those. If you're, number 1, and to me this is probably the most important one, contracts do not transfer. So contracts, if you are in government contracting, or if you are really in any industry, whether it's software, trade, or electrical, plumbing, engineering, and there are multi-year contracts that are associated to this legal vehicle that probably took years to get. And say what you're buying is this future revenue, because that's an asset. You want to buy the customers, you want to buy the brand, and you want to buy the what makes up, usually the biggest thing is the customers and the ongoing relationship that the seller is gonna let go of the customers and the contracts, and you get to benefit from those relationships. But you may have to renegotiate those contracts, and the customer or the the other party on the contract may have an issue with it. And it's something you really have to explore during the due diligence, that making sure that when you buy the assets, the contracts are not going to be an issue, because you don't want to be down the road and realize that the contracts are expiring after this seller because they were hinging on this seller. Government contracts are notorious for that, so you need to really make sure that you don't get the short end of the stick on that. Hey, if this video is resonating with you, please, I need to ask you for a favor. Please like and comment on the video. If there are questions that you have, please go ahead and ask them. I review and answer all of your questions on a daily basis. But most importantly, what it does, it actually helps the algorithm in YouTube spread the word to other like-minded people like you. I am trying to build community, so this will be helpful to me. Thank you so much for helping. Number 2, the tax cost to seller is typically higher because what they're actually selling assets, and it's going to create a transaction that they're going to receive cash in exchange for the assets, which means that they're going to have tax consequences more than they would have if it is a stock sale, because when you're doing a stock sale, the tax ramifications of which are going to be coming later when there is another stock sale. When you the buyer buy the stocks, you will have, the tax consequence doesn't come until later. When for the seller, it's immediate when you're doing when you're selling assets. So there's a tax consequence. So it's a benefit to the buyer, but not a benefit to the seller. Number 3, assets may need to be retitled. So think about it, right? You're taking some out of this vehicle, assets that do not belong to you, and then you may actually have in these assets vehicles, equipment that right now they're sitting under this legal entity, this legal vehicle. We have to transfer ownership to this legal vehicle, which may be cumbersome depending on how big the transaction is, how many assets. Are they fully depreciated assets? Are they new assets? Are those assets free and clear? Because if the assets have loans, it's just more complicated. Cherry picking which is an advantage, also may be a disadvantage for the buyer, the retitling of the assets. Number 4, disadvantage of an asset purchase. Employee agreements with key employees may need to be renegotiated. So everything has good and bad, right? If you remember number 5, the buyer can select which employees, which is actually a good thing if you're the buyer. But if you're the buyer, you're going to have to deal with, what if you have your top salesperson who's been loving working with the company and has been there for 10 years, has a great relationship with the seller. That relationship is no longer, you're going to have to earn the trust, but because now they are at will and they're not subject to an agreement, they may actually end up leaving. So you may actually end up buying the assets, and your biggest asset, which is your employees, some of them may not stick around unless they have a reason to stick around, which is an agreement, which you would have to renegotiate. So those are the things that you have to think about when you're actually buying a business. Okay? Number 5, seller may be stuck with assets not purchased. So you're going to be cherry picking, right? Assets from the seller, transferring those from this vehicle to this vehicle. But you may end up leaving the seller with some stuff that he doesn't want, that he didn't want to have anything to do with it, but he's going to have to get rid of those assets, which actually it's a disadvantage to the seller. So as you can see, we're going to compare in the stock what the pluses and minuses or advantages and disadvantages. But this is the reason why in a lot of the smaller transactions, because of the liability right here, liability being number 1, why most buyers choose to do an asset purchase. I'm going to show you right now what happens on a stock purchase. All right, everybody, now we're going to talk about stock purchase. Okay, advantages. I don't have to explain to you anymore the two vehicles. You already know that. Number one, buyer does not have to bother with reevaluation and retitling of assets, which was something that was a disadvantage on the asset purchase is now an advantage on a stock purchase because what you're buying is the actual vehicle. Okay, so one thing to be clear, the asset purchase, you're actually taking assets, cherry picking assets and liabilities from here. Vehicle remains with the seller. They're gonna put them right here with your vehicle, and you have to retitle them. And you go through the process of change of ownership like a pink slip on a vehicle, right? You don't have to do that because what you're buying on a stock purchase, you're buying all of the stock associated with ownership of this vehicle. You're buying the vehicle itself with everything, good, bad, and ugly. So you're buying this vehicle. The seller will no longer have any claims to this legal entity. This vehicle is now yours. So with that in mind, you don't have to worry about retitling of assets. Number two, the buyer can assume non-assignable license, permit, and contracts. If you are looking to buy a business that is heavy on contracts, and let's say that there's millions of dollars associated with future performance of contracts. Imagine if you're buying a government contracting business that has work in progress of millions of dollars. They're in year one of a $10 million contract and the spend is $2 million a year. When you might have to really talk to an attorney or to figure out if it makes more sense to buy the stock because those contracts will transfer. Of course, there's going to be some legal aspects and there's going to be some legal angling, and your attorney will protect you, making sure that everything is up to snuff and the contract will actually transfer, which is something that you would have to really during discovery and due diligence have to figure it out. But when you buy the stock, everything can transfer because you're buying the vehicle. Number three, buyers may avoid paying transfer fees, which is something that happens on an asset purchase. You don't have to worry about it. And a stock purchase. Number four, must come in. Okay, so remember what I said about the larger transactions? What I've noticed is in transactions that are north of 5 million and beyond, and especially when you have EBITDA earnings before interest, taxes, depreciation, amortization of north of $1 million, most likely the buyer is going to be a little more sophisticated and they're not going to want to deal with the assets or cherry picking anything. They just want to take control of the vehicle. So those transactions, the ones that are favored by hedge funds and private equity buyers, will all be stock purchases. Now, I was involved in two transactions earlier this year. One was a $6 million transaction. The seller had an S corp, but the buyer was a private equity firm. So the due diligence was robust because they wanted to make sure that nothing was hidden, everything was exposed, good, bad, and ugly. But they got premium dollar because private equity buyers and hedge funds are sitting on billions of dollars. And every week I get an email from somebody who's representing either a family office or a strategic or a hedge fund or a private equity who's looking for those precious $1 million plus EBITDA deals that I'll be willing to pay top dollar if makes sense, and they will do a stock purchase. So if you are the seller, strongly considering the stock purchase in that situation, because the hedge funds are not going to do it any other way. Now, with advantages come disadvantages on a stock purchase. Number one, no step up on tax basis, no handpicking of assets or liabilities. Remember the whole thing about depreciation and amortization and the goodwill, the amount of money that you're paying for the assets, is none of that is in a stock purchase. So you're not gonna get to take advantage of that. But think about it, if you are a private equity firm or a really robust strategic buyer, like say somebody who is much bigger competitor than you in buying it, do you think they're gonna really be worried about that? No, they have other means to really capture depreciation and amortization. It has nothing to do with the buying of this business from this seller. But if you're a first-time buyer and you wanted to buy the stock, really you're going to have to really listen to the advice of your CPA or your tax professional advising you on how to best navigate the complexities on the tax side when you actually file your tax returns, corporate and personal, especially if you have a throwaway entity, a disregarded entity like an S Corp or an LLC, you will have to deal with that. Number two, and this is the biggest reason why stock purchases are not very popular among the smaller deals, because you will assume unwanted or unforeseen liabilities. So there is no amount of due diligence you can do. At some point, there is something that is going to be amiss, and there might be some potential lawsuit coming your way to the seller that the seller may not even be aware of. And even under oath, they'll say, no, everything is great. And then just so happens that there is something that is going to come up down the road. It could be a lawsuit, a disgruntled vendor, and depending on the insurance coverage that you had, claims made, or especially if you had claims made or occurrence-based, but claims-made general liability insurance may or may not cover that particular situation. So this is the biggest reason why stock purchases don't happen on smaller deals. Number three, well, when you're dealing with a stock purchase, you're dealing with securities laws, which means securities lawyers, licensed people, which means more money for the transaction. It's gonna, you're gonna have to pay more to acquire. The seller is gonna have to pay a little more because everything has to go through securities lawyers. And most importantly, what was an advantage on an asset purchase is a disadvantage on a stock purchases as a buyer if you have a handful of shareholders who may even be minority shareholders who can block the sale. Okay? So the consensus, if you are the CEO of a company that is, say, doing $10 million in revenue, and you really have the beginning of a hockey stick, and you want to take advantage of the upswing in your revenue, and your projections are great, but some of your minority shareholders don't like the deal, don't like the buyer, and they may actually be holding out, they actually can sabotage the sale, which may be a big deal on a stock purchase. It may actually may kill the deal. So this is sort of the scoop of advantages and disadvantages. Now we cover both stock and asset. Now, you have to do your due diligence. You have to look at what risk you're comfortable with doing and what is the best. There's a legal strategy and there's a tax strategy. So if you're really the buyer, I would say in most cases, an asset purchase may be best. If you're a strategic buyer, or if you're somebody who has a lot of contracts on the table, you might want to consider a stock purchase. Hopefully this was helpful to you guys. Thanks so much for watching this video. For a limited time, I'm giving away my cash flow calculator, a tool that I use every week when I'm analyzing deals on behalf of my customers, my buyers. And it allows you to actually look at the information given to you by the brokers or the sellers and analyze it in a way that allows you to see how much debt you can bring on the deal and how much cash flow is after the debt service. I think is a must-have, and it's my gift to you. All you need to do is click on the link below and it'll be yours to have. Thank you.